So right now we're going to talk about adjusting entry at the end of the financial period for accrued revenues. And so, like we talked about before, let's use the example that we used when we talked about accrued revenue. So you provide a service for customer on account. So that is accrued revenue. So let's just say that you provided service on account in the value of $10,000. So in accrued revenue, when that event first happened, when you first provided service to customers, you will increase account receivable by $10,000, increase revenue by $10,000 because you provided service to customers, and then increase retained earnings for $10,000. So this is what happened when accrued revenue happens. You haven't received cash yet, but you provide a service, so revenue goes up, account receivable goes up, meaning that customers is going to pay you in the future. So let's just say that the customer paid you that money within that year. And so at the end of the year, you have to adjust entry. And so you look at this event, and then you realize the cash that you collected from customers. And so because you received cash from customers, when you adjust entries, you increase cash by $10,000, assuming that you collected all the cash that you need to collect within the year. And then you would decrease account receivables by $10,000 because those customers don't owe you money anymore. So account receivable will go down by the same amount. So this is what happened when you adjust entries for accrued revenue at the end of the year. Note that we do not change anything on revenue or retained earnings because we counted revenue when we recognize the event, recognize the revenue. And so we don't want to double count the revenue at the end of the year. At the end of the year, it's just basically an asset exchange transaction. And so cash increase, account receivable decrease.